2010 is shaping up to be another mystery year. Will there be inflation, deflation? Where will you make money? T.Rowe Price, the big mutual fund company, is on his annual forecast road tour, grappling with those very questions. One of the stars of the tour is Alan Levenson, T.Rowe's chief economist. Welcome, Alan. Thanks for joining us.
Thank you very much.
As the chief economist of T.Rowe Price, what are you telling people, and what is your company telling people about the best places to invest right now?
Well, as one general theme, we're talking about this coming year as being one where stocks are likely to do better than bonds just because bonds have done so well and interest rates are so low. And with the economy recovering, that suggests good things for corporate earnings. And the second theme is just to make sure that you're exposed to international markets. There's been a tendency to have what we call a home bias and to think of the global economy as a very exotic and unknown place. But emerging economies in general are far healthier than they were, say, 10 years ago. And we would caution people that there are a lot of growth opportunities beyond our shores, and so that part of a diversification strategy should include that global dimension.
Are you concerned about the dollar? Does that play into your international interests?
Yes, it does, to the extent, and it's not so much that I'm personally that I would bet on the dollar and going down and that's why I'm looking abroad. It's more for the growth opportunities over time. The dollar is a very hard thing to forecast, but to the extent that the dollar goes down, earnings denominated in a foreign currency, in a Chinese company or a French company, when you bring those back into dollars, increases your return. So.
Okay. All right, good. Just to go back to bonds for a second. Since you think stocks will do better than bonds, do you have any recommendations for where to keep your safe money? If this might be a bad year for bonds, I assume you're talking about interest rates going up, maybe a whiff of inflation. What would be a safe place?
Well, look, particularly in light of what we've been through the last 2 years, to me, safe means only one thing. That's money that you might need to spend at a certain amount of time. And I'm a big believer that you're going to sell assets from time to time, but you don't want to have to sell assets at the wrong time. And so even though interest rates are quite low, if you're sufficiently concerned or sufficiently certain that you're going to need money in a few months' time, put it in the bank and recognize you're not going to earn interest. Other than that, I'd say there are short-term bond funds. We offer one that gets more yield than a money market, but tries to reduce the capital fluctuations. And so that's another option.
Okay. If you were Ben Bernanke, what would scare you most looking out at the economy?
Looking out at the economy, I can think of a lot of fears, that inflation is going to pick up, that the economy is not going to recover. But what would keep me up at night is that if I'm successful in getting the economy to recover, having taken all these heroic measures, having taken all these assets onto the Fed's balance sheet, how am I going to get back to a normal balance sheet and conducting monetary policy in a normal way? Because, again, looking at the economy and responding to it, I think the Fed knows what to do. But the question from where they are right now is when it comes time to tighten monetary policy or to raise rates, it's not automatic that they'll be able to do that as they have in the past.
If they can't raise rates and money continues to flow in the system, what happens then?
Well, if they find that they can't successfully raise rates and they didn't do anything else about it, the risk would be inflation and a weaker dollar. I think that what they would end up doing is selling assets that they have purchased. That's plan B, that's not plan A. But if they found that there was too much leakage in the system to allow them to raise rates effectively, they'd begin to sell some of the, it'll be close to over $1.5 trillion in assets that they've bought as a way to push up interest rates.
Okay, good. Those treasuries and mortgage-backed securities that they've been buying hand over fist.
And it would be risky to do that. It could be disruptive to the marketplace, but I think that they would say that when push comes to shove, better to take those risks, try to send the market a message about where they're trying to get interest rates, than simply to throw up their hands and let inflation go up.
Good. Alan, it's been a tough economy to peer into the future in. So let me ask you a question. As an economist, why should people believe economists about the future?
Speaking for myself, they shouldn't. If you're asking me about forecasting and why should I believe that forecast, I'm not going to insist that you do. I don't have any special expertise about forecasting. I have expertise about analyzing the current situation. And so if you want to ask those questions, that's the reason to listen to me, is because I have expertise there. But nobody is very good at predicting the future, what's going to happen, and even less so when it's going to happen.
Well, that is an honest answer, thanks, but darn. Alan, thanks for joining us.
My pleasure, thank you.
And thank you for watching.